Hello and good afternoon, everyone. Today, 2 o'clock here on September 29th, we're here for another program for the COPEC Daily Financial Wellness Webcast. I want to welcome everybody who's joining us, and we really appreciate you doing that. My name is Jay Linder. I am one of the hosts, along with Jerry Snyder, who is actually going to be our guest today as well. We are excited to provide you this ongoing program, and today we're going to talk about options for paying for long-term care. This is real important for a lot of people because there's a lot of misunderstanding out there, so we're excited about bringing that to you. And again, just to make sure everybody knows, these programs are educational purposes. This is not designed to promote any products or anything like that, so please enjoy the program. And if you do have questions, please chime in. This is an interactive for those that do have questions. If not, we'll have our own discussion here. First of all, the disclosure. COPEC, this is about a little bit about COPEC speakers in the program and also affiliated companies. For example, I am one of the hosts and also on the board, and so therefore we're an affiliated company, so we have some disclosures in there to make that clear. And so take a look at that. You could also see this on the disclosure button at the bottom of the COPEC website, and so you can see that there as well. And if you have any questions or concerns on that, just let us know. We want to make sure that we're completely out there as far as the information and our decisions. So without wasting any more time, let's go ahead and get Jerry on here. And we're going to get into the options for paying for long-term care. Jerry, thanks a lot for sharing us. I was kind of joking earlier, we both have similar shirts that may not come through Zoom very well. So for those that are watching, my apologies if it looks kind of, not very clear there. So, but Jerry, thanks for joining us today. And we're going to talk a little bit about long-term care. And so I'm going to turn it over to you. And, what are we going to get into today? And your mute's on, by the way. Jerry, if you can hear me, your mute's on. There we go.
Oh, we do. And Jay, can you see the screen all right?
Yep, we can.
Good deal. As Jay knows, long-term care is quite a passion for me. I've dealt in this area for about 25 years now. We've had a lot of older adult clients, of course, over the years, and we receive many, many questions on long-term care. So from time to time, I do like to talk about this subject. I was going to start with a couple slides just to kind of review and make sure everybody in the audience is kind of on the same page. I like to start by, again, defining the differences between skilled care and long-term care. And as you can see on this slide, skilled care, we get that care from our healthcare providers, maybe through your employer's healthcare plan, or maybe you purchase individual healthcare. And so it includes, of course, doctors, hospitals, outpatient, lab fees, and even home care to some degree. And so that would be under the skilled care. Long-term care is a whole different set of care providers and care such as what we're looking at the screen now. Skilled care, one thing I think I forgot to put on the slide is assisted care. There's many assisted care facilities that kind of stand alone. So we got skilled care facilities, we have assisted living facilities, continuing care communities. I think you may have heard a lot about those. Those are locations of care that are have multiple levels of care on one campus location. So everything from independent living to assisted living to skilled care on one campus. Adult daycare has become much more important, of course, where we can take a loved one during the day and have them get excellent care and then be able to bring that loved one home in the evening. So they provide a very valuable function for long-term care as well. And then just extended home care. We can do so much more now at home to provide care and keep our loved ones and the older adults in their home setting. And then, of course, even hospice does fall under long-term care for the terminally ill.
Gary, and I know we talked about this last time. Just again to reiterate, acute care is another term for getting better, right? I mean, I know it's not exactly that, but it's getting better. Whereas long-term care, back to your last slide, is continuing care, but you're not getting better, healthier. Correct?
That is very true, and so I'm glad you're pointing that out. If you are improving, you do get to stay on skilled care, but once you plateau, we call it, or go into a custodial type state, that's where your skilled care coverages leave off, and you either go private pay or you've made some plans for long-term care. Another thing, just to touch briefly before we get into the meat of our program, is why plan for long-term care? I think some of these are obvious, of course, but we, of course, want to protect the income and assets that many of us have worked so hard to accumulate over our lifetime. Thing I'm hearing a lot, too, is from children of the older adults or children of the parents, is the parents don't want to become a burden to those children. So we're hearing that more and more, and many children want to help out, of course, either financially as well as physically, but the parents would rather make plans themselves. They don't want to be that financial or healthcare burden to their children. One thing that's gained importance is the independence to choose where you'd like to get care. And so this is very, very important. If you're able to private pay or you've made some additional plans for your own care, then that's going to give you more choices. So that can be very important. We're going to touch on Medicaid a little bit today. And so if one needs to rely on Medicaid, oftentimes they're giving up a lot of choice if they do. They don't have the choice to go the freedom of all the different facilities that are available. Many Medicaid facilities restrict locations and things of that nature. And, as I mentioned before, there's just a lack of other protection from most other insurances for long-term care. And then the cost, again, I won't belabor that. We had a program last week. We got into that a little bit deeper, but assisted living, at least here in Franklin County, we're seeing it run on a low side of about $4,000 a month to more typically maybe $5,000 a month. So easily we're talking about $60,000 a year. Again, if you haven't made plans or you're needing to spend out of your income and assets, again, it can be quite a burden. And then when we go into skilled care, like a skilled nursing home, then that cost can even be much more significant. So in that sense, then let's talk about some of the different options that present themselves to us in terms of funding. Now, as we approach our clients with this issue, we don't want our clients paying for insurance they don't need. So we do take them through some kind of analysis. This slide shows a very, very simple kind of on the back of a tie or on a napkin, you kind of sketch this out. You look at your monthly income, you look at maybe your pensions, your investments, Social Security, and then you kind of apply that against the potential costs that you could run into. And then that might give you a kind of a really, really rough idea of what your shortfall is and what you need to protect and plan for.
Gary, real quick, back on the last slide, would you say, sometimes in the insurance, if you can go back a slide, in the insurance industry, that there's confusion as to how to design that page there, the one that had the thread.
Well, we're all screwed up here, but
yeah, there you go. So sometimes people are confused, and maybe you're going to go into this, but sometimes people are confused. It's like, oh, I need to buy this premium policy, and I know we're not talking specifically about, long-term care insurance as an example,
right.
But when it comes to that, I know that sometimes I've come across clients where they bought this policy that covers all $7,000, and it's like a Cadillac plan, when in reality, they didn't need that much. It's back to your shortfall. And that's what we're talking about here, right? Is to make sure that you're getting, if that's the direction you want to go, you're getting the right amount just to fill the gap.
That's exactly right. So we do find that from time to time, people are kind of over purchasing. And, you know, as time goes on, and again, we're going to expand the discussion beyond just the insurances, but if you have that insurance, you can make adjustments over the years to, as we live longer, your needs actually might decrease because your longevity is decreasing. So you can make adjustments as well. But yeah, we want, if the insurance comes into play, we want to make sure that it's appropriately priced and the appropriately amount of benefits that are needed.
Okay.
Another option that is gaining in importance lately for a variety of reasons is HECMs, or more commonly referred to as reverse mortgages. HECM actually is a form of a reverse mortgage. With a reverse mortgage, you have 3 or 4 different approaches, one of which is this HECM, which has become more popular. But reverse mortgages, as the name implies, is using the equity that you've built up in your home. And the primary purpose of considering it is maybe you don't have a lot of other assets to go to. You want to stay home. You start to need long-term care, but you got to meet those costs of home care. And so the equity in your home may be the only viable source, or it may be a good source. It is designed for people that have reached age 62 or more, so you need to be 62. And again, what you're doing is you're using the equity in your home so that you're drawing that equity out. And even if you still have a mortgage to pay, then you pay that out of your equity as well. Or if your home's fully paid off, again, you can use all of those resources for paying for your long-term care. So they've become much more regulated, and there are just mortgage specialists that you'd want to talk to. We're going to do a high flyover today on that subject, but just make the audience aware that it is an option. It doesn't fit for everybody. And do talk to a experienced mortgage broker if you want to get into that kind of situation. It's very nice because there's what's called a non-recourse loan involved. You're kind of pulling out the equity, and you can never owe more back than your home is worth. And then once you do vacate the home, either you've moved or maybe you deceased, then the mortgage ends, or the program ends at that point. I'm having some difficulty here with some slides, so we're kind of going in reverse here. But the total options then we've talking about here is self-insurance, Medicaid, the HECMs that I just mentioned, and then of course the long-term care insurances. Medicaid, if I can find that slide, there we go. You go through a process of spending down, and that there's pros and cons with relying on Medicaid. Of course, it's the federal and state program that's available to all of us, but again, it does require spending down. So I put up this simple chart to kind of explain it, but here again, I strongly suggest that if we're getting into a deeper look at this and a deeper discussion, that you, like we do, deal with an elder law attorney. We have one, of course, with COPEC, and that you'll be hearing Russ Gollowin. Maybe you've heard him in the past. He'll have some separate programs on this as a standalone topic, so we can really get into it deeply. But when you're going in to apply for Medicaid, they're looking at your income, and they're looking at your assets, and they're going to determine really how much you're going to be able to keep and still qualify for Medicaid. And so you're going to have to spend down and private pay for your long-term care until you reach eligibility for Medicaid. And that highly depends on whether you are single at that point, or whether you have a spouse and a spousal relationship at the time of needing long-term care. The numbers for a single are very, very small. I believe it's $50. Again, we'd want to rely on an elder law attorney for precise figures, But you have to spend down all your income on your own care if you're single. And again, we're presuming you're in a skilled nursing home needing long-term care before Medicaid will start assisting you. And in terms of assets, and we're looking at all assets, retirement plans, we're looking at bank products, we're looking at investment stocks, bonds, all that really needs to be spent down. I think the figure now is about $2,000 is all that you're allowed to keep as a single person. Now, couples, they want to be a little bit more liberal. They're presuming that one of the spouses needs care and maybe has to go into a facility, but the other is able to stay independent. So of course they don't want to bankrupt that independent spouse. So again, the amount of income and assets that the well spouse or the independent spouse, sometimes referred to as the community spouse, can keep are higher, but still it could be very restrictive as to what that spouse was used to living off of in the past. So it varies. We're going to use some general figures. They're allowed to keep anywhere from maybe $2,100 a month to $3,100 a month within income to be able to stay independent. And the reason for the variation depends on what their expenses are and what their housing costs are. In terms of assets, I'm going to give you a rough figure, about $130,000. All other assets, and again, we're talking about retirement plans, we're talking about bank products, stocks, bonds, really all that has to be spent down to a maximum of about $130,000. Now the rules are a little bit more complicated. You're really, what they do is look at half of the assets. And by the way, they're going to look at both spouses' assets. In terms of the assets, it doesn't necessarily matter whose name they're in. They're going to look at the couple together and their total assets. So in that situation with a spouse, however, there are exempt assets before they apply those income and asset tests. And the exempt assets can be a home. There is some limitation on the value of that home. Personal property, the well spouse obviously can keep an automobile, their personal property, and also if they happen to have or want to purchase a prepaid funeral policy, that too can be an exempt asset. Bear with me here, or having trouble with our program here. And I guess that leads us a little bit to the long-term care insurances. We're going to talk a lot more actually next Tuesday at this time to get into those policies a little bit deeper. But the long-term care insurances then can be a viable option in respect to the other options we've chatted about. And they come in a variety of ways that they're packaged to provide the benefits. They can be what we call a pay-as-you-go type policy, where you're putting in a monthly or an annual premium. With those, there typically is no cash value and there's no refund. But for many people, it can be the least costly way of purchasing the insurance. And again, you can kind of buy as little or as much as you need with some limitations. And that's why, as we were talking about before, it's good to get a real good handle on what your gap is or what your needs are so you're not over purchasing. COPEC has given many programs on what we call financial needs analysis or financial planning in general, or financial independence analysis it's referred to. And it's a more in-depth process that you go through, and it's designed to help you answer a lot of questions about your retirement or your ability to create a certain lifestyle. So in that process, we allude to a lot. We think it's very valuable, not only to answer the long-term care question, but many other questions. When do I start Social Security? When do I start my pension? How should I allocate my assets? So again, you're trying to get the best handle you can on what your expense needs are, and then maybe look at different retirement dates coming down the line. And the program will factor in inflation factors and rates of return on your investments, and it looks at just a lot of different options, and you can do a lot of what ifs. And typically we start off that process by determining, well, we're going to assume you're going to live a long life, you and maybe a spouse. Everything's going to go fine. You're not going to need a lot of health care or long-term care. And here's how things are likely to play themselves out for you. On the other hand, then, once looking at that initial process, we want to make sure we account for emergencies or other life events that can happen. What if you and or a spouse would decease prior, of course, to the other spouse, or run into a long-term care need? And we put in some assumptions on that. What if one of the spouses needs 4 years of long-term care, and it's going to cost $5,000 a month or $6,000 or $7,000 a month, like skilled care can run? So we program that out and make those assumptions, and then it gives us a much sharper and a much better idea of what gaps might exist. For some clients, it looks like they can self-fund or self-insure, so we take care of that just with their income and assets. On the other hand, again, if we see this gap that we talked about, then we can resolve that by looking at these different options that we're talking about today. So the traditional long-term care insurance, again, pay as you go, no cash value, and typically no refund if you don't use it. That's, of course, a downside. On the other hand, annuities, and there's annuity type options, and there's also life insurance types options that have been developed over the years as alternatives. And oftentimes using the annuities and the life insurance approach involves more of a single premium approach. You're not paying every month, you're paying every year into the policy. Maybe you pay one time and then you're done. Obviously, that's going to necessitate a larger lump sum option to go into these plans. So now over time, even those type plans are allowing more of a limited pay or a payment over a number of years. So you might pay in over 10 years versus lifetime. Once you've hit that 10 years, then you've paid up for life. So, and there's traditional life insurance available that actually could accelerate the death benefit if you run into a need for long-term care. So those policies are out there in options. Or some of the traditional life insurance policies, they've redesigned them to really come into play more for long-term care. They may pay a very modest death benefit, but they're using a life insurance vehicle or contract to really deliver a much higher long-term care benefit. So again, next Tuesday, as a matter of fact, we're going to get into a lot of these type plans in much greater detail. So regardless, though, one of the objections or one of the challenges, if you will, is how I'm going to pay for this. And so we've listed here some of the different ways that you can fund these policies depending on the type policy you pick out. First of all, can you do it out of cash flow? Are you in a pretty positive situation that after you look at your monthly incomes and you apply those incomes to your expenses, you actually have a margin? And so it might be rather easy for you to take on the insurance premiums on a monthly or annual basis, because you don't have to draw on your assets or your investments to pay that premium. Other people aren't in that situation, so they need to really look at maybe funding this out of their investments. And so we still challenge those individuals is, yes, we're going to have to draw a little bit from your investments, but in so doing, we're going to have a policy that protects your entire asset or your entire portfolio. An example of that might be, let's say an individual, when we add up their non-investments, their bank accounts, maybe even their IRAs or 401k, and let me just give an example. Let's say the individual has about $200,000 of investments. Now, we know this is not going to happen every year, but even kind of looking at a modest growth rate, let's say it's 4% on the 200,000. Well, pretty much year by year, maybe we can count on the investments growing by about $8,000 a year. Well, we found out that, let's say the insurance policy is going to cost us $3,000 a year for coverage that would well cover not only the 200,000, but beyond that. Maybe depending on their age, it would provide 400,000 of long-term care benefit, well covering the 2,000 investments and going beyond that. So we challenge the client, does it make sense? I know it might be tough to kind of pull that out and pay these insurance. You hope not to need it, but by doing that, your accounts are still growing in most cases, but you're using part of the investment earnings to insulate yourself from having to spend down that entire those entire accounts. Capital transfer, another way that might come into play for paying for the long-term care premiums. An example of that is maybe you have a CD or another bank type product in which we know, particularly with current interest rates, are paying the equivalent of very little, or particularly maybe they're going to be taxed as well. So it might actually be kind of a negative rate of return. Well, if the client is not intending to spend that CD in the very near future, or maybe ever, they're always wanting to keep that, then one of these other long-term care products that actually does provide a refund if you don't need it, or it does give you an opportunity to cash out if you don't, if you want to drop the policy later or don't use it later. So you can actually get a refund of most, if not perhaps all of your deposit that you put in the long-term care. So that's, we call it a capital transfer. You're not really liquidating anything to pay those premiums. You're just transferring money from one type of account to another. Have you ever heard of the 1035 exchange? It's kind of a
Jerry, I hate to interrupt, but you know, we're past our time here. Okay. Is there anything you could do to just kind of wrap up a little bit, like what we're going to talk about next week?
Yeah, and we can pick up on these next week if you can join us using other assets that you have and kind of transferring them in on a tax-free basis. So I appreciate the opportunity. Didn't mean to run over. We had a few technical problems. Apologize for that. We'll get those worked out. And love to have you back next Tuesday at 2, where we really are going to get into how these policies work, more so how they're funded and the benefits that can be derived.
That sounds great. Again, for anybody that's listening in, go ahead, let us know if you have any questions. We'll be happy to stick around. Otherwise, thank you so much for joining us. And Jerry, thanks a lot for sharing this excellent information. And we'll be seeing everybody tomorrow for another program. Again, we'll have Holly in, and then Jerry, we'll see you next week.
Thanks so much.
Thanks a lot. Bye, everybody.